Imagine you have a business partner named Mr. Market. Some days he's euphoric, offering to buy your shares for ridiculously high prices. On other days, he's a complete mess, panicking and offering to sell you his shares for pennies on the dollar. The best part? You're under no obligation to trade with him at all. You can ignore him, or you can take advantage of his wild mood swings. This simple story is the key to weathering the chaos of the stock market, and it's the core idea in Benjamin Graham's masterpiece, The Intelligent Investor, a book Warren Buffett calls by far the best book on investing ever written. Graham's philosophy isn't about get-rich-quick schemes or complex algorithms. It's a timeless framework for developing the discipline and mindset to succeed in the long run. The book boils down to three powerful takeaways. First, understanding the wild emotions of Mr. Market. Second, the crucial concept of a margin of safety. And third, knowing the critical difference between an investor and a speculator. Let's dive into these. First is Mr. Market. This isn't just a cute story. It's a mental model for how to view market volatility. The stock market isn't a sage that tells you the true value of a company. It's an emotional, often irrational crowd. The intelligent investor doesn't get swept up in the market's euphoria or panic. Instead, they use its manic episodes. When Mr. Market is pessimistic and offering you a great business for a fraction of its worth, you buy. When he's ecstatic and offering you a fortune for your shares, you can sell. You are in control, not the market. Your job is to use your own research to determine a company's value, independent of the market's daily noise. Second, and this is the cornerstone of Graham's entire philosophy, is the margin of safety. Think of it like this. When building a bridge, an engineer will design it to hold far more weight than it will ever carry. That buffer is its margin of safety. In investing, it means only buying a stock when its market price is significantly below its intrinsic value. You want to buy $1 for 50 cents. This isn't just about finding a bargain. It's your ultimate protection against bad luck, human error, and the wild swings of the economy. If your analysis is a little off or the company hits a rough patch, that deep discount provides a cushion to absorb the impact and protect your principal. Third, you must know if you are an investor or a speculator. Graham is crystal clear on this. An investor is someone who, through thorough analysis, seeks to preserve their principal and earn a satisfactory return. Anything else is speculation. An investor studies a business, its management, its debt, its earnings power. A speculator, on the other hand, is essentially betting on price movements. They buy a stock because they think it will go up, without a deep understanding of the underlying business value. Graham warns that mistaking speculation for investing is one of the fastest ways to lose money. There's a place for speculation, but you must know that's what you're doing and keep that money strictly separate from your true investments. So to recap, the intelligent investor teaches you to build a fortress around your portfolio. You do this by treating the market like your emotional partner, Mr. Market, using his moods to your advantage. You build the walls of that fortress with a margin of safety, only buying assets for far less than they are worth, and you guard the gate by always knowing the difference between disciplined investing and reckless speculation. Graham's most enduring lesson is perhaps this quote: "The investor's chief problem, and even his worst enemy, is likely to be himself." This book is a masterclass in controlling your own emotions to win in the long run. If you found this useful, you might also enjoy A Random Walk Down Wall Street by Burton Malkiel or The Little Book of Common Sense Investing by John C. Bogle. Find more great summaries and reading guides at booksplat.com. Level up yourself today, 3 minutes at a time.